Silver Doctors. Jim Rickards, the guy who's actually going through that seminar meeting thing in Australia in November. That you hear a little promotional thing on my videos here like every other week or so. That Jim Rickards, according to Silver Doctors, he posts from his own site, whatever, but Jim Rickards says, get ready for price explosion. And he's talking about metals. Now, we just had silver over $17.60 or 16 cents. Gold was like $12.90.88, somewhere around there. Of course, it backs down now. The club does a drive-by. It's $12.75, and silver is back down to $16.75. Not that that was a huge drop, but nonetheless, you know what the club does. Having said that, I'm going to give you a special discount code for sdbullion.com, which is the same people here, where you can get a 10-ounce bar, silver bar, Proclaim Liberty 10-ounce bar at spot price if you go to sdbullion.com/jsnip4. New customers only. Also in the link, in the description box of this video, there's a link down there at the bottom with the same thing. sdbullion.com/jsnip4. New customers only. 10-ounce bar at spot price. No premium whatsoever. So what does Jim or James Rickards have to say about this price explosion? And I have to ask, are we so sure it's coming so soon? Wouldn't be the first time we waited around for this, right? But I definitely have faith in this. I feel in my gut, I've always felt this way. Again, you just researching history shows that nothing lasts forever. Manipulation of something cannot last forever. Once you expose it, shine that light on there, it's only a matter of time before the jig is up. And the jig may be simply the miners and producers decide we're no longer using the COMEX as a price setting mechanism. We're done. You want it, we're going to set the price. And then what? Uh-oh. Then Houston, we got a problem. He's not necessarily saying that here, but we're going to see what he has to say. The coming gold breakout, as he calls it. Gold has conducted what some are calling a stealth rally over the past month. After bottoming at $1,206 per ounce back on July 10th, gold is at $1,286 this morning, which again, it moved around a little bit. A healthy 6.5% gain in just over 1 month. And not to mention, I don't think he wrote this article this morning, as in Tuesday. Maybe the day before, whatever. This has been welcome relief for gold investors after a series of flash crashes on June 14th, June 26th, and July 3rd contributed to a gold drawdown from $1,294 per ounce to $1,206 back between June 6th and July 10th. At that point, it looked as though gold might fall through technical resistance and tumble to the $1,150 per ounce range. But the new rally restored the upward momentum in gold we have seen since the post-election low on December 15th, 2016. Gold seems poised to resume its march to $1,300 after the paper gold bear raids of late June. The physical fundamentals are stronger than ever for gold. Russia and China continue to be huge buyers. China bans export of its 450 tons per year of physical production. See, they want to keep it and gobble it all up. They're basically saying, without even having to say anything, you morons can unload as much as you want and export it out of your own countries, but we ain't even kind of. It ain't allowed, keeping it inside. And we're scooping up what everybody else has too. Gold refiners are working around the clock and cannot meet demand. Gold refiners are also having difficulty finding gold to refine as mining output, official bullion sales, and scrap inflows all remain weak. Private bullion continues to migrate from bank vaults at UBS and Credit Suisse into non-bank vaults at Brinks and Loomis, thus reducing the floating supply available for bank unallocated gold sales. In other words, the physical supply situation is as tight as a drum. The problem, of course, is unlimited selling in paper gold markets, such as the COMEX gold futures and similar instruments. One of the flash crashes was precipitated by the instantaneous sale of gold futures contracts equal in underlying amount to 60 tons of physical gold. They unloaded that in paper. The largest bullion banks in the world could not source 60 tons of physical gold if they had months to do it, he says. There's just not that much gold available. But in the paper gold market, there's no limit on size, so anything goes. There's no sense complaining about this situation. It is what it is. and it won't be broken up anytime soon. The main source of comfort is knowing that fundamentals always win in the long run, even if there are temporary reversals. What you need to do is be patient, stay the course, and buy strategically when the drawdowns emerge. Where do we go from here? And I have to cut in with an 80s clip on that one. Where do we go from here now that all of the children are grown up? And why do we give a damn? Wait, something when nobody gives us a damn. Games people play. I shall call it the Alan Parsons Project. Where do we go from here? Sorry about that. August and September are traditionally strong seasonal periods for gold. This is partly due to proximity to the wedding and gift season in India, which is when strong buying prevails. Yet there's more to gold, or the gold demand story this year. Deteriorating relations between the U.S. and Russia will only accelerate Russia's efforts to diversify its reserves away from the dollar assets it has, which can be frozen by the U.S. on a moment's notice, to gold assets, which are immune to asset freezes and seizures. The countdown to war with North Korea has begun. A U.S. attack on the North Korean nuclear and missile weapons programs is likely by mid-2018. Stock market may not have noticed, but the gold market has. This is part of the reason for the recent gold strength. Finally, we have to deal with our friends at the Fed. The strong jobs report on Friday, August 4th, gave life to the view that the Fed would raise interest rates at least one more time this year. Rate hikes make the dollar stronger and are a headwind for the dollar price to gold. But the Fed will not hike rates again this year. He's pretty adamant about this. But the Fed will not hike rates again this year. Once the market wakes up to the reality of a prolonged pause by the Fed, they will conclude correctly that the Fed is once again attempting to ease by forward guidance. This relative ease will keep the dollar on its downward trend and will be a boost to the dollar price of gold. The Fed will not hike rates regardless of the strong jobs report. The reason is that strong job growth was mission accomplished for the Fed over a year ago. Jobs are not the determining factor in Fed rate decisions today. The determining factor is disinflation. The Fed's main inflation metric has been moving in the wrong direction since January. The readings on the core PCE deflator year over year, the Fed's preferred metric, were January 1.9%, February 1.9%, March 1.6%, April 1.6%, May 1.5%, June 1.5%. This is all percent. The July data will not be available until early September. The Fed's target rate for this metric is 2%. It will take a sustained increase over several months for the Fed to conclude that inflation is back on track to meet the Fed's goal. There's no chance of this happening before the Fed's September meeting. It's unlikely to happen before December because of weakness in auto sales, retail sales, discretionary spending, and consumer credit. By the way, all of which I've been screaming at day after day practically since January of this year. So I know exactly those four things very well are not looking good. That would be auto sales, retail sales, discretionary spending, and consumer credit. A weak dollar is the Fed's only chance for more inflation. The way to get a weak dollar is to delay rate hikes indefinitely, and that's what the Fed will do. And a weak dollar means a higher dollar price for gold. Current levels look like the last stop before $1,300 price per ounce gold. After that, a price surge is likely as buyers jump on the bandwagon, and then it's up and away. There's an old saying that a picture is worth 1,000 words, and this chart, which I'll go ahead and pull up, is a good example of why that's true. Makes sense to me, but well, again, when you got tons of paper to throw around, when you think it should be going up, a drive-by shooting, so to speak, happens in the paper market. But again, once there's certain fundamentals, they can, wish in one hand and hope in the other. Reading these prices, it won't matter. They will go up. Gold analyst Eddie van der Walt produced this 10-year chart for the dollar price of gold, showing that gold prices have been converging into a narrow tunnel between two price trends, one trending higher and one lower for the past 6 years. This pattern has been especially pronounced since 2015. You can see gold has traded up and down in a range between 1,050 and 1,380 an ounce. The upper trend line in the lower trend line converge into a funnel. Since gold will not remain in that funnel much longer because it converges to a fixed price, gold will likely break out to the upside or downside, typically with a huge move that disrupts the pattern. At the extreme, this could imply a gold price on its way to $1,800 or $800 per ounce. Which will it be? The evidence overwhelmingly supports the thesis that gold will break out to the upside. Central banks are determined to get more inflation and will flip to easing policies if that's what it takes. Geopolitical risks are piling up from North Korea to Syria to the South China Sea and beyond. The failure of the Trump agenda, has put the stock market on edge, and a substantial market correction may be in the cards. Acute shortages of physical gold have set the stage for a delivery failure or a short squeeze. Any one of these developments is enough to send gold soaring in response to a panic or as part of a flight to quality. The only force that could take gold lower is deflation, and that is one thing central banks will never allow. The chart above is one of the most powerful bullish indicators I've ever seen. Same chart I just showed you a minute ago. Get ready for an explosion to the upside in the dollar price of gold. Make sure you have your physical gold and gold mining shares before the breakout begins. I will also tell you, myself here, do not forget about silver and the silver junior miners and whatnot. They've been hammered this year, monkey hammered. And when the elite jump in the markets, there's blood on the street, so to speak, on the price of an asset. The mining shares are so low these days, like right now, it is screaming, buy me. However, you must have physical silver, gold, etc. I am massively a silver guy because I think the ratio being roughly 70 to 1 with gold, it should be 20 to 1, 16 to 1. For that reason, and the fact that there's a whole bunch more uses for silver, I think performance-wise, silver is going to outperform gold ultimately. But I don't think it'll matter if you own one or the other. You're going to be real happy with how they go. I, by the way, am 100% in silver when it comes to metals. I don't have any gold other than a tiny bit of jewelry that's actually sitting in my safe that we don't wear or do anything with. And I mean just a very small amount. Like if you cracked open my safe and saw the gold in there, you'd be upset that you wasted your time for that. So anyways, again, if you want to start your stacking, if you're a newbie, or you've never been to sdbullion.com, go there, sdbullion.com/jsnip4 to get your 10-ounce bar at spot price for new customers. The link is in the description box of this video towards the very bottom. Same link. Take care.